All right, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, earnings season ramps up. Bank America beats, Wells Fargo misses, and Citi's deal makers are raking in the cash.
And beyond earnings, markets face a packed agenda of more potential catalysts, including a possible Supreme Court ruling on tariffs this morning.
Plus, metals extend their dramatic start to the year with gold, silver, and copper all hitting record highs, oil rising as well.
So I have a look at what those bank stocks are doing pre-market because they're not all doing the same thing. Maybe a mixed set of results after JP Morgan, some mixed results there too. So let's start with Bank of America. Those shares trading 1.7% lower in the pre-market. They topped estimates. Brian Moynihan says that the bank is bullish on the U.S. economy. Citi also beat. Those shares are up, though. They're up about 1.5%. An 84% surge in financial advisory fees in the fourth quarter. Wow. Just as a comparison, JP Morgan was in the single digits, I think something like 6%, so 84% is a huge upswing. Wells Fargo, those are definitely faring the worst, down 2.75%. It's downsizing, and that's cost the bank about $600 million in severance costs, Matt.
Spending money now to save money later. All right, Netflix may revise terms for its Warner Brothers Discovery deal as executives discuss making it an all-cash offer. That could expedite the Warner Brothers sale as Paramount pursues a hostile takeover, Dani.
So a lot to dig through, including economic data. November retail sales out moments ago. They rose more than forecast. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, you've had the last 30 minutes to dig through the numbers. What did you see?
They're relatively good numbers. We see the retail sales overall up 0.6% and a 0.4 gain for the control group, which is what goes into GDP. So those are sign that the economy is still going and consumers are still spending. The PPI numbers, not quite as good, however, and this is interesting because we didn't have October PPI numbers. They're in this report, but this is a September to November change, basically, is what you end up with, and PPI up 0.2 in November, but the year-over-year numbers rise to 3% and 3.5% for the core rate, and that is a difficult situation for the Fed. Interesting thing about the PPI is goods prices in the CPI were flat but rose 0.9% in the PPI, and services prices, which were up in CPI, were flat in the PPI. Not sure how all that's going to work out. The biggest change in the PPI, a 10.5% gain in gasoline prices. We have one other chart to show you here, and this one we put together especially for the man to my left, Matt Miller, because the government has come out with its estimates of new car and truck prices. They said in the report that most of the new models, the prices increases came out in October and November. So as you can see, the average increase for passenger cars is a little over $500, for trucks $1,000, and then they have a category called quality increase. The old thing about your truck can do more and significantly more with trucks than with cars.
But it's interesting that it doesn't match nearly the pace of the price increase, and especially because President Trump was in Detroit yesterday. I'm heading out there tonight to speak with Jim Farley of Ford, so I'll ask him about this. I wonder about the speech President Trump held at the Economic Club. Not sure if you listened to that, but he said that inflation is zero now, and growth is the best it's ever been in the history of our country. After inflation rose to a 49-year high during Biden, and he said then growth was the worst it's ever been in the history of our country. And he repeated these stats a number of times. And I'm just wondering if anyone, well, first of all, are they true? And if not, does anybody in the media ever push back anymore against these statements, even the fake news media?
I understand Matt Miller does, and I have, yes. People do push back on it all the time. And it is inflation is obviously not zero. We see that in the numbers today, one of the highest PPIs in quite some time. And also growth. It is strong at the moment. The Atlanta Fed's GDP now number is 5.1% so far for the fourth quarter. That'll come down. We don't have a lot of data yet, but that's significantly stronger than it has been. But it's certainly not the strongest it's ever been in the United States.
All right. I thought it was an interesting speech nonetheless. Incredibly entertaining. Mike McKee, also entertaining. Thanks so much for joining us, our international policy and economics correspondent. Now, Bank of America CEO Brian Moynihan struck a note of cautious optimism for the U.S. economy as more bank earnings roll in. Let's discuss with Herman Chan, senior U.S. bank analyst for Bloomberg Intelligence. And as I've been following you and Dani all morning covering these bank earnings, it looks like Bank of America beat on trading. Bank of America beat on net interest income by like 200 basis points and beat on advisory fees, which is where J.P. Morgan missed yesterday. So with all of these beats, better than analysts estimated across the board, essentially, why are the shares down 1.5%?
Yeah, it's an interesting topic because the guidance looks really strong as well in terms of expecting continued profitability gains and positive operating leverage. I think there's still some concern out there with a broader economy, the operating backdrop for banks, including what's going on with President Trump and the credit card cap issue. Those things continue to weigh on sentiment. And you should understand that for banks, they were really strong running up into this quarter. So a lot of this might be just some give back.
And the CFO at Bank of America very deliberately declining to comment on the credit card issue. What about Citi? Because this is a big ship that takes a long time to turn around. How much further did Jane Fraser get to course correcting in this latest set of results?
It is a multi-year endeavor, but they're making really tangible progress. You can see that with its efficiency ratio this quarter. That's improved 130 basis points year over year. And they're marching towards its goal of 10 to 11% returns on tangible equity. So we see really strong momentum across its businesses to really reach that goal for 2026.
And Wells Fargo also trying to turn the ship in terms of severance. I think they now have just over 200,000 employees, but they still want to reduce that to capture more efficiency. They're just paying more now, or they paid more in the fourth quarter, right? Over $600 million in severance fees to save money later.
Right, that's right. So they're talking about expense growth about 2% for 2026, which is a really solid cost control measure. They're talking about continued efficiencies, but also investing in their businesses to really improve the operating performance. So we'd expect that to continue. That's one of the big stories. Another big story about a turnaround in the big banks, and we'd expect more progress there as well.
All right, Herman Chan covers the banks for us at Bloomberg Intelligence. Really appreciate your time this morning because I know you're very busy right now. Later today, Wells Fargo's CFO joins the close at 3 p.m. New York time. So Mike Santomassimo coming on with Romaine and Katie at 3 o'clock, right at the top of the show. Oil is at its highest since October, and gold and silver and copper are all at all-time highs. This as traders await the U.S. response to turmoil in Iran and as markets expect rate cuts. Reuters reporting that the U.S. is pulling troops from certain bases in the Middle East right now. Bloomberg Intelligence commodities analyst Mike McGlone joins us. And Mike, when you get a headline like that, the U.S. pulling troops out of Middle East bases, I imagine the rally in precious metals intensifies.
It does. It has. The key thing is it's boasting the precious metals, most notably gold, but it doesn't really make sense in silver. Silver is more speculative at the moment. But the most significant thing right now is you mentioned crude oil. You're getting these bounces on the potential for geopolitics to reduce supply. It hardly never happens. And I think most traders are just looking for these rallies to sell maybe crude oil around 65 WTI. How sustainable is it? The key thing to remember is the whole price maker mantra has shifted over to the Western Hemisphere. The U.S. now is just a massive, in Canada and all of South America, a massive net exporter.
Mike, just given that, I am interested that you get clear reactions when there are headlines coming out of Iran. Yes, you had some in Venezuela, but as you and many have spoken about, there's a lot of long lead times into that actually making a difference. Does it make sense, just given what you're saying, that it's all about Western Hemisphere production, that Iran headlines should be moving this market?
It doesn't, Dani, but look at how much they're moving. We're trading maybe $62 a barrel. It's, last year's low was 55. Last year's high was 80. It's smart prices that are just so beat up. I mean, it's a bear market. The best bounces happen in bear markets. You kind of have to rip out the shorts and you go back down. The key thing to remember is crude oil and natural gas are nearing the end of probably a bear market stage, which means they probably have to get relatively cheap. Any major shift in fundamentals from Iran's not a big deal. If you get a short-term pop, I don't think that matters. But what the producers in the U.S. are just waiting for rallies to sell so they can sell forward and bring on more supply.
All right, Mike, thanks so much for joining us. Bloomberg Intelligence commodities analyst Mike McGlone coming out of Miami. Check on futures right now. We're looking at losses again after 2 days of back-to-back drops. S&P futures down 0.4%. NASDAQ futures off about 0.6%, and the small caps are losing as well.
Some of the other individual movers that are on our radar this morning, Rivian, those shares are falling just under 3.5%. UBS has downgraded them to sell from neutral on elevated expectations and less favorable risk and reward.
Alibaba continues to climb as investors get bullish on its AI offerings ahead of a product event tomorrow.
Another China-related headline, Chinese regulators saying that Chip.com is being investigated over alleged antitrust conduct, but those shares only down 0.8%, Matt.
Coming up, we're going to dive into the banking sector again with Baird senior analyst David George after a slew of earnings coming in this morning and more to come tomorrow. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Iranian protests have surged past, deaths there have surged past 2,500, according to activist groups, as Tehran intensifies its crackdown despite threats from President Trump. A nationwide internet blackout now in its 6th day is limiting information. President Trump urged protesters to keep up pressure while Iran warns of harsher punishments and mass detentions. And the president is again pushing for U.S. control of Greenland, calling it critical to national security and missile defense. He is urging NATO support as well. Denmark and Greenland reject any takeover and point out that in a 1951 defense pact, they have already given the U.S. incredibly broad access in terms of defense. We can put as many military bases and Golden Dome sensors there as we want. Diplomatic talks in Washington aim to cool tensions as Europe warns against changing borders by force. And Saks Global Enterprises has filed for Chapter 11 bankruptcy protection just over a year after taking on billions in new debt to buy Neiman Marcus. The luxury retailer says it has secured $1.7 billion in financing to keep stores open, pay employees, and honor customer programs. The former Neiman Marcus CEO will take over as Saks reviews its store footprint and works towards a turnaround later this year. Dani?
Matt, thank you very much. Now let's get into bank earnings. They continue to top expectations. Many executives are bullish in the U.S. economy in the short term. Let's bring in Baird senior research analyst David George, who's been following the earnings. And David, it's been a huge run up in the banking stocks, trading at near record valuations for many of these companies. Just in the earnings we've gotten so far, who has met the bar and justified that run up in share price?
Good morning, Dani. So both Wells and Bank of America, the two big ones that we cover, their quarters were fine. I would say good. The guidance from both companies, I would say, was generally in line with expectations. Wells maybe was a little bit light. But as you said, I think that the weakness this morning is largely a function of just the valuations of these names going into earnings and really, as you said, Dani, just a really high bar going in. So from our perspective, the weakness this morning is not particularly surprising. In the case of Wells, I think it was up close to 35% last year, BofA up over 20%. So the valuations from a risk reward trade-off perspective just isn't that compelling to us here broadly.
So do you then sell Goldman Sachs? Because it looks like no matter what, bank shares, with Citi as the exception, are falling. I mean, JP Morgan had pretty good numbers yesterday. It was down, 4%? Bank America beat on every single metric, and it's down today as well.
Yeah, we don't cover Goldman, Matt, but we would sell Wells Fargo. We downgraded Wells to a sell a week or so ago. We also have a sell on JP Morgan. So, and that is strictly a function of valuation. JP Morgan trades at 3 times tangible book value. That's unprecedented in the 25 years that we've covered that stock. In the case of Wells Fargo, Wells trades at 2.2 times tangible book, and they just did I think a 12% return on tangible equity. I know their longer term target is 17 to 18%. But in the long tenure we've covered Wells, it's never been this expensive. Even going back to its heyday pre-GFC, it's never been at this valuation. So stocks and companies aren't always one and the same, and this is a case where the fundamentals are fine, but the stocks are overpriced in our opinion.
Well, this time around, Wells Fargo does have the removal of their asset cap. It's only the second earnings where they have that. And it's a Wells that's basically been positioning itself, or at least trying to position itself, for aggressive growth. David, are they going to be able to accomplish that goal? Have they set themselves up, no pun intended, but well enough in order to do that?
Yeah, they are. I would say they are running it hot for sure. They had 5% loan growth this quarter. It's by far the best we've seen for many of the banks that were reported so far, and will probably be the best that we see this entire earnings season. So they are going to grow the balance sheet, we think, very aggressively in 2026. One of the challenges that comes along with that, Wells, over the last couple of years, has bought back a lot of stock. I think they've reduced the share count by close to 25% since the asset cap was implemented. Their tangible capital is now around 6.5%. So their ability to continue to buy back stock at the rate that they've been buying back, and they did $5 billion in the fourth quarter, it's going to be more limited, in our opinion, in the balance of this year, given the fact that they're growing loans so aggressively, and they're going to have to pay for that growth in the form of a loan loss provision, as their reserve is only 1.45%. So there is definitely going to be a lot of asset growth at Wells, which is a positive, but does create some constraints as well.
I wonder about Bank of America, Jamie Dimon. President Trump implied that Dimon wants the Fed to keep rates high because they make more money that way. But isn't the way banks make money on a steeper yield curve? So, like, if the Fed cuts and the long end stays high, then they make more money, not if the Fed leaves rates up.
Yeah, I think you're right. I think, again, the discussion, Matt, around caps on interest rates and Fed independence, that is purely politics and is not something that I'm very good at wading into. So from my perspective, I think that's just kind of political noise, and kind of it isn't really relevant as it relates
I'm just
to the
thinking about it
performance.
because it seems that no one has explained this to President Trump, or maybe he's just pretending he doesn't understand it. And when I saw Bank of America come out with net interest income that was 200 basis points better than expected, even as the Fed's been cutting, it seems that the banks do make a decent amount of money in this scenario.
Yeah, we're in a setup, and BofA is a particular beneficiary of asset repricing on the left side of bank balance sheets as the low rate legacy assets reprice upward from the zero bound in 2021 and 2022. So you're getting a benefit there, and at the same time, presumably a lot of these banks, as the Fed cuts, will be able to lower their funding costs. So the business of making loans and taking deposits should get better, to your point, to the extent the Fed cuts.
David, I mean, you have to wade into the politics to some degree because these banks are. I mean, there's the Bank of America model, which is say that affordability is important, but don't comment on it. But both the Wells Fargo CFO and JP Morgan CFO did get into it, saying it would be bad for the economy and be bad for business. Neither of them wanted to quantify it, David. But if you imagined a world where the credit card business did have interest rates capped at 10%, what would that do to these big banks?
Yeah, in the near term, I think it would do very little, and I think it has next to a 0% chance of happening, Dani. But I think, unfortunately, and we wrote about this a couple days ago, if a rate cap was implemented, it would be terrible for the low-end consumer. You would see credit lines cut drastically. You would see credit availability dry up broadly, and that would be terrible for the U.S. economy broadly. So, again, I think that's more than anything just a political stunt as we go into the midterms. If you notice, that was just a one-year thing that was proposed, at least via the tweet. So I would imagine that this fades away over time. I don't think that there's any appetite in the Congress for any legislation like this. But again, if this would actually hurt the constituency that he's trying to help. So I think to make no mistake about this, it would be very negative.
David, great to get some time with you. Really appreciate it. Baird's David George on the bank earnings says he would sell Wells Fargo right now and has, I believe, a neutral on Bank America shares. Coming up later on Bloomberg Television, as the financial sector closely watches interest rates, Republican Senator Thom Tillis vowed to fight to block Fed chair nominees, any Fed chair nominees, until the Powell investigation is cleared up. He joins Balance of Power at 5 p.m. today. So watch Thom Tillis with Joe Matthew on Bloomberg Television. Listen on Bloomberg Radio. This is Open Interest. Moments away from the start of trading on this Wednesday morning. This is Bloomberg Open Interest. I'm Matt Miller. Looking at what we're seeing in futures, we're down across the board. So S&P futures off 0.4, NASDAQ futures down about 2/3. And this would be the third day of drops if we hold like this through the close. Though it comes off, we come off of all-time highs. So maybe just taking little profits. Maybe this is the pause that refreshes, as Adam Johnson likes to say. Ringing the opening bell at the New York Stock Exchange. Black Spade Acquisition 3. That's Dennis Tam there, who runs it, and they haven't bought or targeted any purchases yet. So this is just essentially a shell of cash ringing the opening bell at the NYSE. That's all.
What would Black Spade buy?
I think they're into like entertainment and leisure stuff.
Yeah.
This is obviously the third fund.
I'm saying if it's not Vegas related, I will be wholly disappointed.
They have like $150 million to go out and buy something.
Cool.
SPACs are back. And at the NASDAQ, you've got Enview ringing the opening bell. Ticker is Feed, and the stock is down 99.9% in the past 5 years. So I hope it's a charity, because if you bought those shares, you're just giving that money away.
That is tough. Hey, Matt, I'm looking at some of the big banks here at the Open, and these shares have rallied a lot over the past few years. So expectations were high, and maybe that's why you're seeing Bank of America getting clobbered. I don't know. It's down pretty significantly, down about 3% this morning. Yes, it topped estimates. The bank is bullish on the U.S. economy. Maybe expenses a little bit worse. Citi, that is the turnaround story that keeps paying dividends. Dealmakers, they posted an 84% surge in financial advisory fees in the fourth quarter. Just as a comparison, most of the other big banks only in the single digits. Wells Fargo, that's certainly about expenses. Its profit estimates missed. It's been downsizing, so that means it's going to cost the bank more than $600 million in severance costs. But Matt, as David George of Baird told us, it's all about the rally up in these shares, hence why they're getting punished this morning. Yeah, they've done very well, certainly for investors. And I know that the valuations are rich because I listened to Cam Dawson. She's about to join us, but I've heard her talk about this previously. So Netflix may revise terms for its Warner Brothers Discovery deal as executives discuss making it an all-cash offer. That would make it more attractive, maybe expedites the deal to buy Warner Brothers. Paramount, pursuing a hostile takeover, hasn't sweetened the pot. So essentially, everyone's just kind of changing the terms around, maybe moving the breakup fee, but not upping the bid, which I think is pretty interesting. By the way, I saw a new Netflix movie, a premiere last night. It's called Rip. The Rip. Very good. Netflix is going all in filmmakers, apparently. The Rip. The Rip.
And you saw it in like a movie theater?
Yeah. Well, like a giant one in Lincoln Center, yeah.
Ah, that's cool. So on a screen, cool. You didn't like sit home and buy it on Netflix.
No. I saw it on a screen and it was great, but it's going straight to Netflix, not to movie theaters. So
yeah, that's the problem.
That is
this
the problem.
Is the problem.
And that's why some filmmakers are kind of like edgy about this Netflix deal.
Right. That's what David Ellison at Paramount wants to stop, he says. Right. But the thing is, Paramount is a $14 billion company looking to make a $100 billion deal. Netflix is a $400 billion company.
Correct.
So much more.
And now offering all cash, maybe.
Yeah, perhaps. We'll watch very closely. We're all interested to see what happens here. Joining us at the desk, as I mentioned, NewEdge Wealth Chief Investment Officer Cam Dawson. And Cam, I got to kick it off on bank earnings because, that's really the big market news of the day. And it's interesting that a lot of these banks, like Bank of America, it does well on every measure and still sells off. Is that just because it's run up so far so fast?
It's a perfect example of the adage, heavy is the head that wears the high bar, because we've seen these stocks rally so much over the course of the last year. And a lot of people will talk about banks being cheap relative to the S&P 500, but it's better to look at them on a price to book value basis. They're trading in together at 1.6 times forward. That's the highest price to book value we've seen them trade at since prior to the great financial crisis. You also have really high earnings expectations. If you look at the 2 years of earnings growth that the banks have just experienced on a forward basis, they're actually growing earnings faster than the period prior in the run up to the GFC. And of course, we remember the GFC, they were YOLOing their own prop trading books and lending mortgages to anybody that had a pulse. And so when we look at the banks, we just have to appreciate that the bar has gotten very high, which explains some of the negative share price reaction.
Should we use that frame to look at many of the companies that are going to reporting earnings this season? Is the bar just incredibly high given the run up in the entirety of the equity market?
I think that likely is going to be the story coming out of the fourth quarter. If you look at the contrast between the estimates going into the second quarter and third quarter earnings season, what we could see is that they got cut following Liberation Day, and then they never got raised going into those earnings seasons. That led to big beats as we had the earnings seasons for 2Q and 3Q. Now that we're in 4Q, you have seen earnings estimates get raised over the course of the last 6 months, and that is also the same for 2026. 2026 earnings estimates have been getting ratcheted higher over the last 6 months, and they're now sitting at $310 a share, 15% growth, and 12% growth in 27. That's important because remember, we will price in 27 growth over the course of 2026. So it's more important what we do to those forward estimates, very forward estimates, over the course of this year.
I'm looking for the January effect. Were we up the first 5 days? Because I think you said it was really important. It's a 50-50 chance, right?
Oh, I didn't say that. No, actually, no, I didn't. I didn't do the January effect, but noting that we are in the fourth year of a bull market, and that's where you get a 50-50 chance as to whether or not it extends into a fourth year, or we see more turbulence. And also note that this fourth year is coinciding with a midterm election year, which also tends to have both a higher volatility and lower returns than the other years during the election cycle. So fourth year bull market, midterm election year, that would suggest expect more volatility and lower returns.
I can't tell, Cameron. I listen to you on Bloomberg Radio all the time. I watch you on surveillance, and I can't tell if you're bullish or bearish relative to the market.
Yeah.
What do you think?
Yeah, defiantly neutral.
Yeah.
Yeah. Look, I think that the path of the market is going to be determined in 2026 as to whether or not you take the over or the under on both GDP estimates or earnings growth. And so what I mean by that is that are we going to be revising up GDP estimates from here? If we are, we think the market can rally. If we can't, because you say something like maybe the consumer disappointing, for example, which has been the wrong bet over the course of the last 3 years, then we would expect the market to be much more choppy and trading. So we're opportunistic. We find opportunities throughout the market. We've definitely seen huge shifts in leadership, and I think that that's creating a lot of opportunities for people to rebalance portfolios.
Cameron, just before you go, I want to ask you, because this is a market that feels really nervy about geopolitics this morning. There was a Reuters report that personnel are being moved away from U.S. bases in the Middle East. You're seeing oil prices rise, European gas prices are rise. Maybe that's due to that's causing some of the weakness in this equity market. Typically, the trade is geopolitics maybe has a sharp initial reaction, but then you can fade it pretty quickly. Is it different if it centers around Iran and oil supply?
Exactly, yes. The geopolitics that you should care about is whether or not it's going to have a lasting impact on oil prices. That's why the invasion of Ukraine by Russia in 2022 was such a challenge for markets, because it caused gasoline prices to rise to a peak of $5 in the summer of 2022, leading to higher headline inflation, leading to more pinching on consumer demand. Real wages were falling during that time, and that's what led people to cut GDP estimates and cut EPS estimates. We've been in a period for the last 3 years of falling gasoline prices on a year-over-year basis. If that changes, that's when we start getting to that over-under on GDP and EPS, saying that could be the exogenous catalyst for revisions down and thus a more choppy market.
Oh, and also goes against everything Trump is trying to do with affordability, right?
Yeah,
If all of a sudden you have to pay more at the pump.
Exactly. And the one point is that affordability at the pump has not been the problem. It's been in all of these other areas. So we've seen disinflation in gasoline prices really consistently. How much lower can they go? And could that be the wild card of gasoline prices moving higher that could throw a wrench in all of these disinflation expectations?
Hey, Cameron, this has been so fantastic. Thank you for joining us. Great to see you. That's NewEdge Wealth's Cameron Dawson. About 9-10 minutes into your trading day, let's get a check on equity markets this morning. We are lower, down 0.4%. There has been a kind of rotation that's been going on. It's exacerbated by what Cameron was just talking about. Energy prices moving higher this morning into some of that nerviness of this market about what is happening in the Middle East. So a lot of the energy majors doing well this morning. Exxon, Chevron, those are near the top of the pile. Costco having a good day. So actually a lot of consumer companies doing well too. Johnson & Johnson, Procter & Gamble, ConocoPhillips. So it's consumer companies and energy companies that seem to be doing well. It's tech that's not doing well. Again, it's the rotation. Tech not doing better, even though it led the market yesterday. NVIDIA, Broadcom, Microsoft, Amazon, Tesla, the Mag 7s leading the pack for worst performers. Bank of America short after, not too far after that, after their earnings. The bar is high. Some disappointment there. Wells Fargo also at the top of the pack. The sectors are exactly as you'd imagine them, just given that. Energy doing really well, as are consumer staples. 1.6% for energy, consumer staples up 0.6%. And again, it is that rotation. Tech at the bottom of the stack, down 1%. Matt, the rotation alive and well, and the question is it sustainable, or is it just very short-term moves in reaction to some concerns on the geopolitics?
All right, very interesting trade, very interesting discussion with Cameron. Speaking of sustainable, Meta is turning to nuclear power to fuel the AI boom, and Oklo is right in the middle of that, or hopes to be. We'll talk to Jake DeWitte, the company's CEO, to talk about why small reactors could be the future of this technology. And we'll get a check on how far along we are in actually making one of these things commercially viable. This is Bloomberg Open Interest.
Let's see what the sell side is saying this morning. Let's get your top calls, the upgrades and downgrades. First up, Goldman Sachs. They have reinstated Hyatt with a buy. They expect Hyatt's room revenue growth to pick up again this year, helped by its focus on the more affluent traveler who continues to spend. Goldman also highlighted Hyatt's outsized benefit from global events. They said that the company has one of the highest exposures to the World Cup, which I would like to get a ticket to, and I hope Zoran Mamdani, our mayor, helps me do so. Next up, TD Cowen upgrading BlackRock, saying it still believes in the company over the long run, but sees little near-term upside. The firm says there is no clear reason for the stock to move higher as investors look towards 2026, leaving BlackRock more of a wait-and-see story more than a fresh opportunity. Shares down 1%. And finally, KeyBank says that Oracle looks cheap after its recent slide, arguing the market is undervaluing both sides of the business. The firm believes Oracle software and its cloud unit are each worth more on their own than what the stock reflects today, making shares attractive. Even so, shares down 2 3/3%, Matt.
All right, let's talk about nuclear power, Dani. Meta is going nuclear to power AI, and Oklo is on the front lines. The tech giant signed a 20-year agreement with a number of providers. Oklo, though, front and center in terms of the small nuclear reactor technology development. The deal highlights surging power demand from AI, as if you needed it highlighted, and also renewed interest in nuclear energy as a reliable, clean, long-term solution. Joining us now to talk about the partnership is Oklo's CEO, Jake DeWitte. Jake, this is super exciting stuff. Like many people, I first heard about this technology or the idea of it when I watched the Bill Gates documentary. I think it was on Netflix, and there was a whole series dedicated to this. How far along are you in kind of the prototyping and the testing of all of the subsystems for your small nuclear reactor? How close are you to like NRC approval?
Yeah, well, I think, so basically we're working towards turning our first plant on come 2027 on the commercial power side. And thank you guys for having me. It's pretty exciting to talk about this stuff. But I think what we see, though, is there's some acceleration that's really happened in the policy space in the last really, 7 or 8 months. Back, on May 23rd, the president signed in the executive orders that introduced this thing called the Department of Energy Reactor Pilot Program, which we became part of to basically bring forward building a first plant much more quickly. It's great because it also dovetails well with regulatory modernization going on there, as well as the Nuclear Regulatory Commission licensing, to then allow us to kind of scale those things forward. But what that looks like then is if you think about a first plant coming online, producing power, getting built, getting that experience between now and 27, because we broke ground in September, it's a pretty good trajectory to then to see follow-on plants on, for example, the 2028, 29, 2030 timelines, which ramp well into what Meta's timing and the need set is for this Ohio site.
Jake, just thinking about the politics at the moment, to your point, this is a White House that is very much so been concentrated on affordability. And of course, energy is a really big part of that, going as far as talking about Microsoft taking on a bigger share of some of their data center energy consumption. In your conversations with the White House, how much has that come up? Are they pushing you and helping you to move faster in order to get more things online to help with the issue of affordability?
Yeah, they are. And I think what's great, though, is this really is the bipartisan thing, right? Like under President Biden, they signed in the Advance Act, which brought forward accelerated regulatory modernization. And when people talk about that, what does that mean? It really just means bringing more modern approaches, the state-of-the-art capabilities we have on design, modeling, simulation, to understand what really matters for the permitting bases and reflect that in the processes so they move faster. Technology has changed a lot from the 1970s. So letting those kind of things organically evolve accordingly, let me rephrase that, letting them, pushing them to evolve accordingly is important. This administration and this president really accelerated that further. And we see that happening now. I mean, we have this wild thing happening where you have all this demand happening, and it's not just AI. We're bringing back industrial capacity in this country. We're bringing back manufacturing. It needs power. It needs energy, and we don't have nearly enough of it. So seeing the opportunity to then come forward and provide new generation is key. And this administration has worked really hard and continues to say, hey, we need to bring more power plants online sooner. What can we do to make that happen, including making federal resources able, and I'm not talking about just money, I'm saying sites, land, permitting acceleration, infrastructure they have that could be used. And this Ohio site is actually a perfect example. It's an old nuclear facility that produced enriched uranium for our industry and was a huge beating heart of that. Unfortunately, it went away, but that site still has great infrastructure that now we're able to come in and build on and expand on that. That's a great example of being able to work in a multi sort of faceted manner with the government to accelerate bringing more power online sooner. And this is key. These data center companies, the hyperscalers, they need new generation. They can't just be buying the electrons on the grid. That's key for affordability.
I will say Ohio is pretty perfect. Dani, if you haven't been there, I recommend going to the great state of Ohio, regardless of the Buckeyes' loss on New Year's Eve. It's a fantastic place to operate, to live, to grow up. Jake, I wonder about bottlenecks other than land and permitting and finance. And I'm thinking specifically about labor. Are you getting access to the amount of skilled labor that you need, considering that there must be so much competition for it right now in a labor pool that is not growing?
Yeah, that's a really interesting place, and it really helps to be one of the first movers because it gives you first access, because we don't have enough labor pools in this country for everything that's coming. I was at a dinner last night, and an individual said electricians are king right now, and there's a lot of truth to that, right? Like, we have a huge shortage, and there's a real need for this. We feel good about where we're at and what we need, but it's also affected our strategy. We're really focusing on a couple areas that make a ton of sense, including the great state of Ohio, that has a huge amount of, frankly, labor infrastructure that works here. And there's a lot of competition for it. But in this site, for example, where we're building, it was one of the largest uranium enrichment complexes in the world. They have been decommissioning that facility, but there's a ton of skilled labor there that, honestly, they've been looking at jobs going away because of the decommissioning going forward. Now we're bringing them back. And they're there, like the people, the talent is there. So it's a huge benefit. And that's why, for example, when we pick these sites that we're going to be going heavily into investing in and building a lot of power plants, it's because partly, you have that workforce in hand and in place to build off of. I mean, it's very exciting to see what that entails for the local community and the economy, but also how that spurs more. I mean, just to get back to that, I think the Midwest has incredible labor market, so it's a pretty exciting place to be developing.
And I'm sure the great state of Ohio has been very happy with the buzz marketing that's been happening for them this morning. Jake, we're going to have to leave it there. Thank you so much for joining us, Jake DeWitte of Oklo.
Can I just say we have already, if you include William Henry Harrison, who was actually born in Virginia, but preferred to make Ohio his home, the most presidents of any state come from Ohio.
I thought it was Virginia.
Well, no, that's because I'm saying William Henry Harrison was actually born in Virginia, but he wanted to be from Ohio.
Well, we created him, so I think we still get it. Okay, coming up, Ford gets flack for forcing a delay to congressional hearing about car affordability, and they respond. We'll have their response next on Bloomberg.
Ford's CEO is pushing back against criticism from Senator Ted Cruz of Texas about car affordability. Bloomberg's Keith Naughton reported on this and joins us now from Detroit. And Keith, it's a timely story because we just saw in government figures that Mike McKee was highlighting earlier how much car prices, not specifically Ford prices, but across the industry have risen far faster than car values.
Right. Yeah, no, the average price of a new car, Matt, is now over $50,000, which is really luxury territory. So it's really shutting out a big part of the market to mainstream buyers. It's becoming a market just for wealthy people. So that's why Ted Cruz wanted to have this hearing in Washington, but he wanted to do it this week. And this week also happens to coincide with the opening of the Detroit Auto Show. And Jim Farley, Ford's CEO, said, I'm just too busy.
And he's going to be busy talking with Matt Miller tomorrow, too. We should also note the programming.
I'll be there. Keith will be there as well.
Oh, yeah, you both will be there. I'm looking forward to watching those conversations. Keith, it does feel like Ford has been really entangled in politics. I mean, it necessarily has to because of tariffs, because of affordability. There was this issue of a worker at the Ford factory heckling President Trump. The Wall Street Journal reporting this morning that Ford has suspended the factory worker.
And President Trump gave him the finger.
And President Trump did indeed, it would appear, is giving him the finger in it, too. I mean, this is a president who is not afraid to target specific companies. Keith, is Ford in a really difficult position at this moment, just given the events of the past couple days?
Well, it is definitely a heated political moment. The president being here, that factory tour, the heckler and the president's response, which, yes, the White House called appropriate. He held up his middle finger and used an expletive at the worker. Yeah, lots of heat at the moment. Ted Cruz was also harshly critical of Jim Farley for skipping this hearing. Said he was trying to swindle taxpayers and that he cost Ford $19 billion because of the write-offs they're taking on their EV assets. But Farley's response was, "Hey, I'm running a car company, and that's my priority."
Yeah, understandably so. Keith, I look forward to seeing you and Jim Farley tomorrow, as well as Laurent Mekies from Red Bull and Max Verstappen, arguably
so cool.
The greatest racing driver alive today.
Lewis Hamilton.
I said, well, okay, maybe historically,
yeah,
right?
Okay, like
but
current.
I mean currently.
Yeah, fine.
Coming next hour, we're going to discuss the nonstop market rally with Victoria Fernandez of Crossmark. Has it come to a stop? We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. We've already had catalysts of bank earnings, of higher oil prices with concerns about Middle East tension, but we are awaiting the potential big catalyst. Will we get a Supreme Court decision on the legality of IEEPA? They declined to do it last time. But in the meantime, we are having another piece of data coming out, and that is December existing home sales, Matt.
Yeah, not likely to be a huge catalyst for market moves. However, we have brought Michael McKee, Bloomberg's international policy and economics correspondent, here on set with us to look at the numbers. And I think especially in light of the mortgage rate discussion and, MBS purchases, et cetera, it's interesting, even more interesting to watch the housing sector.
Well, we have seen rates come down some, and we have some good news on existing home sales. They're up 5.1% in the month of December, which is fairly strong, considering that's a month when a lot of people aren't out buying houses. Annual rate of 4.35 million, 4,350,000. I don't have a comparison on how much that is compared to previous months, but it is a reasonably strong number. It's up from 4.14 million, so a significant gain. And we did see the Mortgage Bankers Association report a big gain in mortgage applications last week, and especially refis. So we're seeing some...
Because rates have come down so much.
Because rates have come down so much, we've seen some reaction. Also, one other thing, Anna Paulson, who's the new Philadelphia Fed Bank president, just out with her latest comments on the economy, and she says that she sees inflation moderating, labor market stabilizing, growth coming in around 2% this year, and she repeats what she said just a short time ago. If all that happens, then some modest further adjustments to the funds rate would likely be appropriate later in the year. She did talk a little bit about the import of Fed independence, but she didn't mention Jay Powell or the President of the United States.
Also, very strong retail sales data today, Mike, which, I mean, maybe kind of goes against this idea that rates are moderately restrictive.
Well, and we saw a big increase in the PPI, producer prices, particularly for goods, which fall under the tariff category, and that suggests that inflation is still out there, and we may see a rebound in the CPI coming up.
All right, Mike, thank you so much for joining us. That is Bloomberg's Michael McKee breaking down the latest economic data for us. Joining us now is Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, I would love to know how you're thinking about this moment and what's most important for markets, because we're getting bank earnings and more generally the earnings season crossing. The economic data is finally coming in after the government shutdown, and we might get a ruling from the Supreme Court on IEEPA. For you, what moves the needle the most?
Yeah, well, Dani, I think you've got a list of items there that any of those could move the market pretty significantly, depending on what we hear. I think when we're looking at a longer term market, when we're looking at people that are investing for the long term, it's the earnings that are really going to be most important right now. Are we going to continue to see that double-digit earnings growth that people have become accustomed to as of late, both on earnings and high single digits on revenues, profit margins continuing to grow like 13, 14%. So I think earnings is going to be critical. Typically, you know, the banks are pretty solid on earnings and set us off on a good foot. We've had a little bit of mixed earnings here on the banks, but overall pretty good. So I think that's something we're really going to be watching, because as we know, earnings then flows through to the labor market, to layoffs. So I think that's probably where the focus will be. There will be a lot of knee-jerk reactions in regard to the Supreme Court decision, and there will also be reactions to any kind of geopolitical tensions happening as well. But I think earnings is our focus.
Yeah, I mean, with regards to that, what kind of earnings growth do you expect? We were talking yesterday with Anastasia Amoroso, who said, you know, the street's looking for 8% growth, but we often beat by 4, 5, 6 percentage points. So are we going to get 12, 13% earnings growth again in Q4?
It seems almost incredible, Matt, that we would get another round of that double-digit earnings growth. I mean, if you know, when we talked earlier in the year, I would have never thought we would have seen growth as much as we have. I do think you're going to start to see some of the issue of tariffs come through as companies start to rebuild inventories. A lot of the costs have been pushed down the line a little bit because they front-loaded and they had that inventory and they weren't having to replenish. Now we're going to start seeing some of that come into effect. So I think that's why we're seeing expectations a little bit lower than where they had been in previous quarters. But these are still strong numbers that are there. We'll have to see if the consumer, especially the high-income consumer, continues to spend. You mentioned retail sales. I mean, that core retail sales group that flows through to GDP, 0.4%. So a little bit lower than the last report, but still a strong number. So that high-income consumer is key. And then add on to that middle-income consumers. The NFIB, that small business report's a good proxy for middle-income consumers. And that was pretty positive this week as well. So that bodes for a pretty strong earnings season once again.
Is this a market, you know, I'm looking at the bank performance, Victoria, and like, especially with Bank America, where it beat handily on at least every segment that a layman like me looks at, and still the shares sell off. Is this a market where you have to do better than beat? I mean, do we really need good news to drive stocks even higher? Or are there sectors you like that aren't facing the kind of high bar problem that the financials have?
Yeah, it is a very high bar. Financials have done very well. It's been one of our favorite sectors over the last year and continues to be a sector that we really like. We would actually use the pullback in the financials to add to some positions there because we think we're going to see a steepening of that yield curve as we go throughout the year for a multitude of reasons. But mainly that term premium, I think, is going to push that longer end higher. So we think financials is an opportunity to buy when it pulls back like this. But yes, sectors, I think, or companies are going to have to report even better because we have come into the year with high valuations, a high bar. So what is going to be the upside surprise that really continues to drive this market forward? Earnings could be it, but they're really going to have to surprise us to the upside. And we're seeing that rotation in the market right now. So there are those other sectors you can look at. Healthcare, you can look at materials, industrials. These are all areas that are starting to turn. And believe it or not, staples actually hit a 3-month high relative to the S&P. So they're maybe starting to turn a little bit when they have been struggling for so long.
Victoria, maybe adding to this is what we're getting and going to continue to get out of the White House. It's something you've been writing about, that midterm election years tend to be one of high growth because of policy. This feels like that on steroids, Victoria, with affordability type policy being proposed left and right. How do you think about that, what that does to the growth engine of the United States and what it does to the risk of increasing or at least making inflation sticky as it is now?
Yeah, it's a double-edged sword because, as you mentioned, there is this component that really can help kind of juice the economy, at least here in the beginning of the year. We see it from the big, beautiful bill that's coming through. We see from tax advantages for individuals, for corporations with the CapEx component. These are all things that will be beneficial to growth and help the economy. But yes, at the same time, if you continue to put excess liquidity into the market at a time, really, when you're looking at financial conditions that are not really tight, you're not looking at credit that is, saying we can't find credit, we can't get loans, and yet you're putting more liquidity into the market, that can drive inflation higher. And so that is a concern that you have to see there. I think in the near term, though, it's going to be the boost from these programs that's going to help support this market in the first couple of quarters. And in a typical midterm election year, you do see that drawdown probably in the middle of the year going into the third quarter as the excitement from all of those policies starts to wear off that has already been priced in. So we would be watching for that pullback later in this year.
You're right, especially if those policies hurt significantly the businesses in which you're investing. Victoria Fernandez of Crossmark, really appreciate your time today. I want to quickly get a check on the markets after a couple days of drops. We're looking at the S&P again falling now 55 points. It still is over 6,900, I should say, 6,909. So a relatively high level. The same is true of the NASDAQ, even though it falls more than 300 points at 25,421. It's not insignificant, though, 1.25%.
No, it's really not. It's a real kind of like rotation-y feel. We had it yesterday, too, right? Tech sells off.
Yep.
Staples do better. Energy does better, too. But a lot of that has to do with the geopolitics. Some of the single stocks that we're looking at this hour, Bank of America, those earnings did top estimates. Brian Moynihan saying that the bank is bullish on the U.S. economy. But, I mean, that's not the important thing, right? Because shares are down 4.4%. Expectations are really high. Maybe some concerns about costs going forward. So shares down 4.5%.
Imagine if he said he was worried about the U.S. economy, like just freaking out. That would be even more problematic. I mean, they beat on every aspect, and they're still down almost 5%. Citi also beating estimates as dealmakers post an 84% surge in financial advisory fees in the fourth quarter. So this is the bank that is turning to a positive tack, and yet investors selling it off to the tune of 2 2/3%.
Yeah, when shares opened, they were up 1.5%. That is a big change. Worth getting a look at Wells Fargo because it's been selling off the entire time because they actually did miss on a lot of things. They missed on profit estimates. They're downsizing, which means more costs for them. It's going to be $600 million.
But eventually it means less costs for them, right? This is, I think, they're pay now, so that you don't cry later.
Right.
It makes sense.
Okay, but when the shares have run up more than any of the other big six banks,
true,
you maybe don't care that it's eventually going to pay off. If there are costs now, you maybe sell.
True, they have been crushing it in terms of performance. Coming up, President Trump repeats his demand for the U.S. to take control of Greenland, and he says it's for national security reasons. We'll talk more about that next as we await Supreme Court decisions. This is Bloomberg Open Interest.
Some breaking news. We're awaiting a potential Supreme Court decision on IEEPA. We have not gotten it. The Supreme Court has finished their rulings for the day, and they have not ruled on Trump's tariffs. Joining us now is Anne-Marie Hordern, Bloomberg's chief political correspondent, co-host of Bloomberg Surveillance, who, like all of us, has been waiting for the Supreme Court decision. So we continue, Anne-Marie.
Me, everyone in Washington just keeps hitting refresh on the SCOTUS blog, and we don't have an opinion yet again today. The president spoke about this last night in Detroit. He was saying, could you imagine the Supreme Court is trying to rule that my tariffs are illegal? But then he did say, we'll find another way. So for financial markets concerns, although everyone does want to know whether or not this is going to be deemed illegal, there's going to be a time period if it is deemed illegal where your companies are going to line up for refunds. About 75% of Trump's tariffs are tethered to IEEPA, so they're going to have to find different avenues to legally have these justification for some of these tariffs. So that is why everyone is so concerned. But yes, the Supreme Court really leaving us in the dark once again, unclear how they're going to rule on this.
As an aside, did you see the story in the New York Times about the dude who started the SCOTUS blog?
No.
Like big bets and concubines, and I highly recommend checking that out. You saw it, right?
Yes.
Yeah, okay.
That's an old story. Yeah.
Mike, let me ask you about, we only have one decision day left, right? So they have to come out with this.
Well, it's not that there's one decision day left, but before the end of the month, we're looking at 2 argument days, and today was an argument day as well, which they could release decisions next week on Tuesday and Wednesday. There's an order list issuance day on the 26th, which could also be a venue for it. But right now, they are running out of time, but they could still do it. But the court doesn't feel a time pressure. They're going to do what they do when they do it. And as much as it drives us all crazy, and I'm sure it drives Donald Trump crazy, we just have to wait until they're ready to tell us what they think.
All right, well, we appreciate both of you sticking with us. Mike McKee, obviously following the economics and policy issues of the day for us. Anne-Marie Hordern, our chief political correspondent, also co-anchor of Bloomberg Surveillance. Fantastic show this morning. I was watching that as well.
Thank you so
In
much.
fact, I pulled some sound from Surveillance from Stephen Kim, which I thought was a fantastic interview that we're going to be playing later on. We want to continue the conversation, though, on Washington with Henrietta Treyz, economic policy research director at Veda Partners. Henrietta, I guess it's just speculation at this point, but I'd love to know what you think the Supreme Court is going to say with regards to tariffs, because President Trump has brought it up so much. Yesterday, he said again that it was his favorite word in the dictionary. Then he downgraded it to 5th because his wife, his kids, religion, and Jesus come first. But the point is, he really loves tariffs, and he's really worried that the Supreme Court will stop these tariffs through IEEPA.
Man, at this point, I don't care what they say. I just want them to say it, my base case with 65% odds is that they're going to uphold what the lower 2 courts have already told us, which is that Article 1, Section 8 of the U.S. Constitution explicitly gives the power to tax to Congress. And the president is taxing us to the tune of $3 trillion over a decade for direct executive orders, which is not how the Constitution and the framers intended it. So the core of this question is whether a tariff is a tax. It's very nerdy if you want to get into it like that, but obviously global trade hangs in the balance.
But for these companies who have been putting their names in this lawsuit, hoping to get some sort of relief, hoping to get a refund and reimbursement if this is ruled illegal, Henrietta, how difficult do you anticipate, even if this were to be ruled illegal, the use of IEEPA, how difficult do you anticipate it to be for corporations to actually claw back those costs?
It's extremely complicated. So you saw probably Costco is the most notable example of a company that preemptively filed back in November to make sure that they were in the queue to get a refund. And they didn't just expire or miss their opportunity to seek a refund because the statutory 314 days to liquidate and get a refund on your import had gone by. So there's a huge queue of those companies covering about $129 billion worth of goods as of December 10th. So the list of companies that will be seeking relief here is very long. It's going to go back to the Court of International Trade. I do not expect the Supreme Court to rule on this. Indeed, when they had the oral arguments, you could tell that the justices were kind of overwhelmed at the idea of having to also rule on how the refund process was going to go. So for investors anticipating one big lump sum going back into the economy, it's very unlikely to shake out that way. It's going to be very staggered if it comes at all.
I can't imagine why it would be so complicated. I mean, the importers of goods pay the tariffs, and they must keep meticulous records of prices paid. Certainly, CBP keeps records of the money they receive. I mean, isn't it just a matter of matching up receipts and asking for the money that you're owed?
Yeah, it is in some ways going to be really cut and dry. These processes are gone through every single day. Anybody importing is going to change some of their harmonized tariff schedules. The tariff rates change. They can seek refunds. I mean, sometimes the president just takes the tariffs off. So there is a process for this, but there are, hundreds of thousands of product lines and importers that are going to queue up for this. My understanding is that the Treasury Department does not have a working group ready to go to process these refunds. And obviously that 314-day period has now lapsed if you started collecting tariffs before December 15th. So that's sort of the state of play that we're working with.
So that's one of the complicating elements of this, if this does get ruled illegal. Henrietta, the other one, and many people pointed this out, Anne-Marie has done a great job outlining the different venues that the president has available to implement tariffs through different parts of his authority. But this is also a president who's been making a huge affordability push. Henrietta, do you think that will color the willingness or the extent to which the president going forward will add additional tariffs should the Supreme Court undo some of his original work?
I am so glad that you brought that up. And Anne-Marie talks about this all the time, and it's such a critical part of this, that Bloomberg has sort of a story out right now about this being a Big Mac cycle, where we're going into the midterm elections. When you look at the election data and polling data, the issues of prices and affordability are the #1 concern of 24% of Americans. Below that is jobs and the economy, eating up almost entirely what the voters care about this year. For reference, in the latest Economist YouGov poll, foreign policy is the top concern of 1% of Americans. So if you're going out and you're looking at President Trump and he's talking about capping credit card interest rates or getting into the housing markets and mortgage rates for 50 years and other sort of affordability level progressive agenda items, you're not going to get that through Congress. What's the most effective way Trump could effectuate stimulus to the U.S. consumer? Let the tariffs roll off and keep them that way. And that's our sort of very outside consensus view that we've been posting about since November.
Well, we have Henrietta viewers write in who I guess are angry about the amount of money they've had to pay for goods and ask or even demand that tariffs go back to consumers, which doesn't compute in my head, but I get, how they make up that equation. Is there a chance that the administration would then order importers who are refunded tariffs, if that becomes the case, to then somehow give that money back to consumers who have essentially overpaid for their goods?
That's a great question. How about what are you going to do for the people who got fired or whose wages have not gone up instead of the auto dealership passing prices along to consumers? What about the idea that the refrigerators that you are paying a little bit more for, but what about the manufacturer who lost his job in that plant because of the tariffs and the margin squeeze? There's no good way to do this. And one extra layer of difficulty here is that the ambassador, USTR Greer, is telling us that they're just going to cycle into new tariff authorities. So not only do we need to be concerned about where the revenue is going to go once we return it, but do we just reimpose those tariffs, writ large anyway? Does the EU let us keep collecting those tariffs? It's the importers that pay it. They're going to ask for a refund. Those trade agreements are toast.
Can you just put all these two ideas together? More tariffs or keeping them on, then you have affordability push, the Big Mac trade, all these together, Henrietta, what does it say about where the U.S. economy is going in 2026 and more specifically where inflation is going or not going this year?
I mean, not to state the obvious, but the Fed has a very difficult job. I mean, if all these tariffs come off, then the inflationary impact that, Goldman Sachs and others are expecting into the first quarter of this year as they, stop just squeezing margins and start passing prices along to consumers. Now, all of a sudden, those are upended. unless the president imposed them through some other mechanism. For the U.S. economy, this could be a huge basket of relief for the U.S. consumer. Average households are paying $1,800 a year in tariffs as a result of the actions the president took last April. So that would go back to the consumer, and it would take off those artificial price increases from tariffs. So the Fed really has to parse through both of those things. But inflation's going to go up if they get the money back, and presumably if the tariffs continue to rise.
The consumer has basically a $1.3, $1.4 trillion credit card balance, and President Trump has said he's angry about that because it's running like 20% interest, maybe a little bit more than that. He wants to lower it to 10 and actually has said that starting January 20th, credit card issuers who don't cap rates at 10% will be breaking the law. That's only 6 days from today. Is that an implication that he's going to issue some kind of executive order? Because currently there's no law that caps credit card rates at 10%, obviously. Is he going to try and put something into effect that does cap rates?
Not only is there a physical impossibility of passing a law by January 20th, but you don't have the votes for it, even if you did have the members in office voting.
Can he use IEPA?
Well, theoretically, now that the Supreme Court has, staved off tariff decisions until at least next week, he could try to get something in there. But that's sort of ridiculous to assume. It's kind of the same as the Iran tariffs at 25%. We haven't gotten details there because presumably those would also be effectuated by IEPA. The president is trying to write legislation from the executive branch. And to go back to the Constitution, that is precisely what our founders said they did not want to have happen. And that is what the president is trying to effectuate. You can bully pulpit, you can try to govern through tweet, but there is no law. And the credit card rates are not changing. And even if you wanted them to, you do not have the votes, and you most certainly do not have time to do it before January 20th. So that's not an option.
All that's not stopping him from expressing his desired policy, Henrietta. Peter Scheer from Academy had this thing earlier in the week basically saying, if you want to think about the policy coming out for 2026, like it is anything. It is use your wildest imagination, and that's probably what will get it. Is that also kind of how you're thinking about the policy pipeline? Maybe pipeline's the wrong word. The policy wish list, let's say, from the White House.
The wish list is long. And it's great because this is an opportunity for the president and every single member of Congress to go to the list of bills that have already been filed, take the ideas from their competitors, take the ideas even from the other side of the aisle. That's why Trump has got Warren on the phone. It's a good idea to appeal to a populist base. It doesn't work for the banks. It doesn't work on paper. And obviously will have massive implications for consumer lending. But that's irrelevant if it plays well in a midterm election year. The election is the way that investors should view all of 2026. Nothing else matters if you don't first put the layer of this is an election year in front of you. Color everything through that. It is the king in D.C., especially with a very proactive, sort of fiscal dominance-oriented president.
Henrietta, thank you so much for joining us this morning. Henrietta Treyz of Veda Partners.
$200 billion in cash. That's where the cash is coming from to buy. What about the next whatever? Let's say they do another $200 billion. They raise the cap. Where's that money coming from? You got to borrow. You got to pay interest, and you got to hedge that interest rate risk. Guess what? That's expensive. In addition to that, you got the Fed. You got the GSEs coming in. They're a big, voracious buyer. But they're existing MBS buyers out there, right? You're going to see probably the MBS buyers step back, so you could have more displacement then you actually have net addition. And that's another reason why you might not see the spreads come down as much as some people hope.
That was Stephen Kim of Evercore ISI speaking on Bloomberg Surveillance earlier, and it reminded me of a conversation. A man told me that exact same thing last week, and he joins us now on set. Neil Grossman, TKNG Capital co-founder and former CIO. Neil has spent 3 decades in the financial industry working as a trader, asset manager, and an advisor to central banks. I've known him for almost that long. Neil, you were just saying the same. You were texting me the same thing when we got news of the order, President Trump's order, for Fannie and Freddie to buy $200 billion in MBS last week. We have seen mortgage rates come down, at least initially. How do you think this is going to play out?
I think the world is going to, or the markets are going to set where the rates are going to be, ultimately based on a lot of other factors, Matt. Look, the gentleman, I think Stephen was saying exactly this. Fannie and Freddie don't have $200 billion of idle capital. They go out and borrow. That's been the way that's operated for generations. And, $200 billion of what will be agency securities hitting the market. They usually try and match fund the structure. So you'll have short, medium, and long-term bonds coming out. That usually has a significant effect on the spreads. It'll affect market volatility, it'll cause yield levels. And in general, mortgages are priced relative to where the agencies can borrow. So it ultimately will be more likely than not to maybe push rates up a bit, unless you're going to force everybody to be issuing short-dated floating rate mortgages because the Fed's cutting interest rates. Now, the other thing that what you didn't talk about there was, it's almost, if you're going to do that, the agency's almost acting like the Fed because they're basically pouring more money into the market as well. So that, this is just it's gimmicky in a sense. If you really want to bring rates down, the first issue is you got to bring inflation down, because that's a big piece of this. And understand, part of the problem with the functioning of the home market is exactly that inflation's been too high. So if you cut rates a lot, the odds are it pushes prices up. There's a relationship between rates and prices. It doesn't take a lot of pushing prices up to offset that. Keep in mind, if I'm in an existing home, usually you want to trade up. So when I move to a new home, I'm usually buying something more expensive, so I'm incurring more borrowing costs at higher yields. I'm functionally giving up my current loan, which might be lower. The cost of insuring has exploded, so I'm insuring a higher priced asset, which is costing me significantly more. The cost of moving is expensive. The cost of upgrading is expensive. The cost of decorating is expensive. By the end of it, a percentage drop in rates may be a fraction of what the incremental costs are. You want to get great things. So one of the things I've talked to a friend of mine in Washington about is, what if you made mortgages portable and transferable? So if they're
talking about that.
Right.
They're considering that.
Yeah,
the problem is, how do you then value the new asset, right? And who gets to value the new asset? Because that's the asset that keeps your rates down.
Well, if I'm borrowing on a house, the house, you sort of have a pretty good idea of what the house value is. And, yes, you can go look at it. If I want to move somewhere and I've been paying a mortgage for 6 or 7 years, I've demonstrated my credit, paying capabilities. And the mortgage is outstanding in any event. So you can have it either way you want. But again, that's not the be-all and end-all. Another way you could lower the rates, get rid of the right to prepay.
I was going to say, that's the Ackman proposal, right?
Right.
Prepay, have a penalty there. But people would hate that.
Well, you're going to lock people into homes. But what you could do is say you can't prepay your mortgage for 5 or 6 years, or something of a limited duration, so that the cost of the optionality will drop.
How much of a difference would that make?
You have to look at the structure of the market. You have to look at the structure of what bond. A 30-year prepay is different than a 10-year. That is different than a 5-year. A floating rate mortgage would not have much impact, if any at all. But then again, the problem with floating rate mortgages, if you watch what happened in England, for example, that was all they ever used to issue. When you had inflation problems in England that pushed rates up, it really had a terrible effect on the economy.
Neil, what do we do about, when you want to hold inflation down, you've got to think of labor costs, right? And you think about this a lot. Yep. I know, because we've talked about this a lot, hire only people that are allowed to be here, that are documented, and pay all the necessary fees around employing people. That labor pool is shrunken dramatically. So yep. How do you... And the undocumented labor pool also provided a lot of other people work. Right. With that labor pool gone, how do you keep down construction costs? How do you keep down, insurance costs? How do you keep down tax costs?
You probably don't. And you're going to have to, this is the part of the problem when you try in the short run, things distort. And then the question is, how do those distortions propagate over time? And it's a problem. Look, forget just that. Look what happened 3 years ago in the aftermath of COVID and all the inflation. Some of the companies were making massive pay increases, right? I forget, Ford was 30 or 40%, UPS. Do you think UPS laid off a lot of people recently just because? No, their cost structure was significant. I think when you look at this, look, let's segue a little bit. This is the problem with the Fed. They've done, and I've said this to you before,
yes,
they've done a miserable job. The only reason people think they've done a good job is because stocks have gone up. Stocks are not the Fed's mandate. Price stability and employment are their mandate. Employment's done pretty well. but we've had a horrific period now, 5 years of excess employment, inflation. They've never gotten to their target. And the inflation, I think inflation is much more impactful on labor now than rates are.
That's exactly where I wanted to go with you, because you have had a lot of, you've had a critique of the Fed performance, to put it lightly. And yet, I imagine you would defend, regardless of all your criticisms, Fed independence. And that has come under severe attack.
Well, first of all, absolutely. If you want to go back and have a history lesson a little bit, the Fed's independence was created in 1951 with a Treasury Accord.
Right.
They didn't really have it beforehand. And the Fed was forced during the World War II and the post-war years to keep rates very, very low artificially, and you had a massive thing. What I will tell you, though, is the Fed is not independent, and I'm not even talking about vis-a-vis the politicians. The Fed panders to one audience, and that is the markets. And you can't listen to any analysis of what the Fed's going to do or not without them saying the markets won't like that.
Regardless, Neil, I have to ask you, when the administration starts to have the DOJ investigating the Fed
should
chair...
not be. And by the way, look at the number of other issues in Washington that have had staggering cost overruns. Nobody, almost nobody, has ever been indicted. If I were the president, honestly, I would have called Chairman Powell in and said, "You're fired. You've done a terrible job. You were supposed to keep inflation under the control, and everything that's going on now is problematic because you folks didn't do your job." You did, and the idea. I mean, even his last statement. We're going to get to 2%. How about when? Right? They've been saying they're going to get to 2% now for 4.5, 5 years.
Well, and by the way, to keep it at a steady 2%, they really need to go under.
They
right?
have to keep
because
under.
It's been over for so long.
And by the way, to follow on what was the original mandate, not mandate, but what they'd set their policy structure in the aftermath of the great financial crisis was inflation averaging, because they wanted to push it up. It will take you 20 years at 1% to unwind the excess inflation that they've allowed to create. And again, this is a big piece of the problem in this economy. The lower half, 2/3 of the population are struggling. I actually think the effective rate of inflation is much higher.
But could we also have a scenario where some of the independence is chipped away at because you have a Treasury and a Fed to work together to do things like lower mortgage rates? Don't you need some interdependence for that to even happen?
I'm not saying no. There's nothing wrong with these parties working together. And again, that was what actually resulted and ultimately brought us out of the 40s into the 50 problems. But the question is, under what circumstances and how? So, for example, when the Biden administration put the second COVID relief package into the economy, the Fed should have said, we're going to have to start removing liquidity at some point. Otherwise, we're going to have really long-lasting problems. The administration would have said, well, you can't do that. They would have had to find a way. You want to find a way to bring down, housing, the cost of debt relative to housing prices, and you want to bring down the price of inflation. You're going to have to do
We've only got
something.
here 30 seconds,
Okay.
but I wonder, who would you pick? Who would you pick to replace Jerome Powell?
Of the stated
Yes.
people out there? Well, my gamble, if I could have found it on Coshley or whatever, would have been Donald is going to name himself. But of the other four, I think Kevin Warsh is the most outstanding of
Neil,
the
always great to spend time with you. Hope we get you back as soon as we can. Neil Grossman, former founder, I should say, of TKNG Capital, former CIO there as well, also one of my oldest friends. Coming up, policy uncertainty is looming over Wall Street ahead of the midterms. We'll discuss what one strategist is calling the Big Mac trade. This is Bloomberg Open Interest.
There was Tina, then there was Taco, and now we have another acronym. Big Mac, a play on big midterms are coming. The idea is policy implications from this fall's congressional vote will be a major theme of 2026. Joining us now is Nathan Dean, Senior U.S. Policy Analyst for Bloomberg Intelligence. And Nathan, I mentioned this earlier in the show, but one of my kind of favorite things on this was Peter Scher from Academy basically saying, think outside the box. All policy options are on the table. Is that how we should address this, that we could get anything and everything from the White House on affordability in the coming months?
Absolutely. And the key word that you just said there was affordability. I mean, look, that is one of the most important things that American voters are thinking of as we head into November. And we've seen just this past week, President Trump really take steps that are outside the Republican, I'd say, establishment playbook in terms of embracing some, I would just say, Democratic policies to try and get that affordability message through. But the key thing to note is that President Trump doesn't have a lot of power here in terms of trying to get things through Congress. We don't anticipate much legislation happening at all. And so it's really this idea of the bully pulpit, that social media post that comes out and says, look, I want to ban credit card interest at 10% effective January 20th. And there's really no mechanism that he can do that, but it's still forcing industry to respond. And in that case, those credit card bank issuers are still down 6-7% since where we were earlier this week. So certainly something to play in terms of this year is just trying to figure out how do you deal with the bully pulpit portion of the White House, because that message is going to continue throughout 2026.
I wonder about, I was watching Bloomberg surveillance this morning, and John and Anne Marie had a guest talking about the credit card caps and saying, look, that's not going to happen. It's a very low probability that we get a 10% cap on credit card interest. But there is something that legislators are considering right now on swipe fees that's far more important because it's very likely. What is the story with credit card swipe fees, and what are we watching for?
Yeah, so this is called the Credit Card Competition Act. If you've flown through JFK LaGuardia, you may have seen the adverts about this saying, look, this bill will take away reward programs associated with airlines. What this does is it requires additional competition so that if you're a bank, you're required to offer your merchants Visa and another network, MasterCard and another network. Can't be Visa and MasterCard. Now, the idea here is that more competition equals lower fees and less revenue and less, for the banks. And the reason why this is more of a risk than that ban on interest that I talked about earlier is that there's bipartisan warmth to this idea. This is something that Senator Dick Durbin and Senator Roger Marshall have been pushing for many times. Now, we have a 40% chance of success in 2026 on this. We think that there's this unspoken Republican group out there. Think of the bank-allied Republicans in the House Financial Services Committee, for example. They're most likely opposed to this. But as pressure continues on the banks in terms of this idea of affordability, look for more momentum on this. And ultimately, look for both of the bill sponsors here to try and attach this to another piece of legislation. Think maybe the government funding bill at the end of the month. Think of something else rather than going through markup. And the reason why I bring that up is because it can happen almost instantly. You'll get the headlines associated with it, and you'll have headline risk for those bank issuers as well.
It's been endlessly fascinating, and in some cases boring. In the case of Bank of America, to see what bank executives have said, and I say boring for Bank of America because the CFO was basically like, "We love affordability. We really care about affordability, and on the credit card issue, we will not comment." Nathan, what have you kind of gleaned from what some of the banking executives have said about the credit card business and their willingness to push back against Washington, D.C., or even prepare for changes, whether or not they happen?
So I don't think you're going to see much pushback from the banking industry, specifically against the White House, for two reasons. One, they don't want to get into a spat with President Trump because President Trump has shown that he's willing to use that bully pulpit all the way through the elections, and that's not something the banks want. But there's another angle here. The banks are getting a lot of love right now from the Federal Reserve and the other banking regulators in terms of two proposals that we're anticipating coming out fairly soon, the Basel III Endgame and the G-SIB surcharge. Now, you take all those together, back of the napkin math, plus another rule that they finalized at the end of last year on leverage ratios, you're looking around 60 to 70 billion in returned capital to those largest banks. So even though right now they may not be happy with the White House on the credit card interest and the credit card business, they are going to get capital returns coming from those regulators. And ultimately, I think that's the focus for 2026. So I don't think you're going to see many statements from the banks on the White House social media posts.
Hey, in terms of policy you're watching for, Stephen Kim of ISI this morning was saying when he saw the order on defense companies not to pay dividends or execute share buybacks, he instantly thought of the home builders because they have given back significant money, returned significant cash to shareholders. Do we get something like that on home builders? Does President Trump say you're not allowed to pay dividends and buy shares back either because you're not giving us enough supply?
Absolutely. I mean, look, any industry right now, if it has any ties to affordability, most likely will get some look at from the White House. But let's talk about what can happen in that scenario. So President Trump says, right, home builders, you can't issue dividends. Well, there's nothing he can really do to says we're going to do that. But there are other ways to influence policy amongst that industry. One, he could say, look, you're not going to do any business with the federal government. All federal contracts, you can't really do that. Or he's going to say, look, we're going to have regulators look at you even further, and we're going to look at your practices here and see. And it's just a headache that the home builders won't want to deal with. So what I think you'll see from the industries that are targeted from the White House is similar to what we saw in the credit card space. The bank said, look, we're not going to, we don't think that there's a law here that will cap credit card interest at 10%. But maybe we can offer a credit card that is capped at 10%. Maybe we can offer a different type of program here. There's different ways of thinking it from the industry perspective. And so these industries have to be careful that they are going to get the focus, but ultimately what their response is going to be is also going to be very important to keep in mind.
I guess it's still giving the president a win of some sorts that he can brag about for the midterms without completely upending their business models. Nathan, so great to have you on. We had you on for a while, even though you're not wearing a vest.
But the sweater is very dadish. To be fair, the V-neck he's America's dad. If you watch Bloomberg Balance of Power, and by the way, how psyched are you to see Tom Tillis on at 5
Very
p.m.
excited.
today? Yeah.
That is the conversation to watch. The congressman who has been pushing back against some of the concerns around Jay Powell. Nathan Dean, thank you so much for joining. Coming up, we're going to bring you part of our interview with the CEO of Delta following a cautious earnings report. Stay with us for that. Delta CEO Ed Bastian is warning that President Trump's push to cap credit card interest rates at 10% would hurt banks and lower-end consumers. He spoke on Bloomberg Surveillance with Lisa Abramowitz.
I think the banks that have already come out and spoken about it are expressing a tremendous amount of concern. So I understand it would require legislation, is what I'm told. And we know the challenges of getting anything through Congress these days. I also think the knock-on effects are pretty significant when you think about what seems to be maybe a good idea to help the lower income strata, give them some income tax or not income tax, some interest rate relief. The reality is going to eliminate their ability for credit. And it's going to freeze up tremendous amount of credit lines that the banks aren't going to be able to afford to provide. So I'm not, it's not my business. Of course, we're going to work closely with American Express. The second factor is that Amex is a premium card provider. So that's really not the income level that we focus on in our business.
At the same time, there is a sense that that's a growing part of the revenues. We saw an 11% increase in the contribution that this particular aspect made to Delta's revenue. So I just wonder, how much do you expect that to grow, all things being equal?
We're expecting high single-digit growth. In the current year, we've been seeing double-digit growth for the last several years, and it's a really important part of our business model. But I don't think it's something that we look back and start getting concerned. I think this idea has a lot of roadblocks and obstacles ahead of it.
One thing that you said in an interview with a colleague talking about what could great look like is that effectively all the growth that you've seen so far has been from the premium cabin, not from the main cabin. Why do you think that is? Is it because of just incredible strength at the premium end, or is it because of weakness in the main cabin?
I think the main reason is the demand set for the premium seats and the premium product that we offer is continues to be at a record high. The more we look at the health of the consumer, we talk about the K, we're at the top end of that K in terms of who our consumer is. And when you have a high demand set, that's what drives pricing strength, and that's what drives the growth that we've seen over the last several years.
That was Ed Bastian, the CEO of Delta Airlines, speaking with Lisa Abramowitz on Bloomberg Surveillance. Quick check of what's going on in the stock market. An hour and a half into the session, we're down 1% on the S&P, now under 6,900 at 68.94, 68.95. The Nasdaq down 1.6% as Nvidia, you can see behind me, falls fairly substantially, down more than 2.3%. Intel is up 1.7%, but so much smaller that it doesn't even come close to outweighing the weight of an Nvidia. Bank America off almost 5%, even though it beat on almost every metric with Q4 earnings. Citigroup had an amazing turnaround with investment banking advisory fees up 84%, and still it's down 2.5%. Wells Fargo down 4.6%, or paying more than $600 million in severance. So costs are higher to keep them lower later. But look, these bank stocks have had such a big run up that investors are taking some profits today. And then Netflix off 2%. Interesting, just because Netflix is rethinking its offer for Warner Brothers to potentially convert it to an all cash offer, maybe more enticing to get a deal done faster. Tomorrow, I'll be in Detroit, Motown, sitting down with one of the biggest CEOs in global trade. Jim Farley of Ford joins us. Also the head of one of the most valuable teams in sports, Oracle Red Bull Racing, and arguably the best F1 pilot alive today, who's currently driving and winning, although he didn't win this year. Max Verstappen joins us on Bloomberg Television. This is Open Interest.